Today's episode is called Into the Weeds and Numbers.
Educate your money now.
Hello, and welcome to Educating Your Money podcast. I'm your host, Kristen Curry-Case, owner of Matnick Bookkeeping and Tax Solutions. I hope everyone is staying safe and healthy. Today's episode is called Into the Weeds and Numbers. We will be discussing the cannabis industry and best accounting practices. Hold on tight because this is going to be a big one. We would like to thank Out and About Business Solutions for sponsoring our podcast today. Today's guest is Ryan Milam, enrolled agent at Polston Tax Resolution and Accounting. Ryan is an IRS enrolled agent at Polston Tax Resolution and Accounting with locations in Oklahoma, Kansas, Nevada, Missouri, and nationwide. Ryan runs the cannabis team at Polston. He specializes in business structuring and compliance for the cannabis industry. Ryan has chosen to dive deeper into tax strategy to become an expert in taxes for his clients so they don't need to be the experts. Hello, Ryan, and thank you so much for coming on the show today.
Hello, thank you for having me.
Definitely. So if anyone has been awake for the last few years, you should know that the cannabis industry is hot and it's a hot topic. And so many have taken their hand at developing businesses in this industry. But there is so much more to the industry when it comes to accounting and the numbers. And I think we will hit most of those points in this episode. So if you have a business in this industry or looking to create one, you will definitely want to watch this episode. So Ryan, there are so many questions around this industry. So let's just jump right into the weeds. So I guess the best place to start would probably be at the beginning. What type of business structure should someone looking to create a business in this industry consider, or does it even matter?
You know, it is something that should be heavily considered. And you're right. This is it's a very new industry when you compare it to many of the other industries we have in the United States, where there's a lot of precedents. And, you know, with the automobile industry, with the construction industry, they've been around for some of them hundreds of years. Cannabis, some of the oldest states who've had it legalized are just over 10 years. And so we're still in a phase where we're setting precedents now. And so, you know, what we have to go off of is just our experience and our experience with the IRS. But, you know, right now, that's one of the most common questions that I get is for new people looking to get into this industry, how do I structure my business? And there's a handful of choices, and it matters a lot when it comes to tax and accounting. In general, there's an exception to this, and I'll explain that afterwards. But in general, I'm a big fan of setting up everything as just a straight LLC. Whether it has more than one member, it's going to be a partnership LLC. If it's a single member, it'll be a single member LLC. But the reason I like that is because it gives us flexibility. When we're first starting, what we tend to see is, say that you and I are going to start a cannabis business together, and we decide to form a partnership LLC, and then we begin our licensing process with the state. Well, inevitably, there's almost always some unexpected delay happening with that. And if we jump the gun and we set up as a corporation too early, as a S corporation or as a C corporation, prior to us really engaging in business and making money, it can actually cause some unnecessary taxes to become due. And we don't want that. But what an LLC does is, if we start this LLC today, say by the end of this year, we end up not doing any business activity. Well, then that's fine. There's not going to be any taxes due. But then if we get midway through next year and we're making a fortune from this, we probably don't want to be taxed as an LLC at that point. But by having an LLC in place, we can choose to send off for a corporate election. We can look at S corporation, C corporation. It's hard to give one of those as your primary structure. It's going to depend on a lot of factors. But we know that once we are profitable, we're going to want to be one of those two. You know, the one caveat I wanted to explain is that the only time that I wouldn't look at that is if we know out of the gate that we intend to become a publicly traded company, then we really have to start off as a C corporation. Our hands are kind of tied in that way. So that's really the only way I wouldn't recommend starting as an LLC.
So what are the different types of businesses or areas that someone in the industry can go into?
Yeah, so they kind of break down into a couple of categories. There's going to be direct plant touching businesses, which would be your main three are going to be cultivators, otherwise known as growers, processors, also known as manufacturers. So let me back up. The cultivators are actually growing the plant. The manufacturers and processors are turning that raw plant material into oils or edibles, or they're changing it from a plant to something else. And then you have dispensaries or retail businesses. Now, typically, the retail is the only people who can sell directly to the end user. Cultivators and processors have to really sell to each other or to a dispensary, and then the dispensary sells it from there. However, there's a couple other kind of ancillary businesses, such as transporters is one of them. And then we have kind of an array of non-plant touching or semi-plant touching businesses. You have crews of trimmers. They contract to cultivators when it's time to harvest, and they don't buy or sell the plant, but they just help trim it. You may also have, like I mentioned, the transporters. They never really necessarily take ownership of the product, but they're just hired to transport it. But on those industries, we may discuss this a little more later in the show, but there's some serious things that you have to look at hard, and I would recommend that you talk to an attorney to figure out if your business is considered plant touching or non-plant touching. In short, I can almost guarantee you, if you hold a license in your state, you probably are a plant touching business.
That's interesting. Yeah, I am sure that there's quite a bit of difference between the two. Like if you do, if you touch it or you don't, I'm sure there's a whole list of different things, rules,
Yes.
regulations associated with each of those.
Different rules for different ones. And you may have, some people have multiple businesses and have different rules for each business, and it just becomes that much more complicated.
So can one business owner create a business in multiple areas of the industry, as you were talking about?
Yeah, in most states you can. And in some states, that's the only way you can do it, actually.
Oh, really?
So, I live in Oklahoma. I have clients in many, pretty much every state that there's legal cannabis. But in Oklahoma, for instance, where I live, there are three primary licenses: your cultivation license, processing license, and retail/dispensary license. And one person could have all three of those, and it would be called a vertically integrated operation at that point. And in other states such as Florida, that's the only way you can do it. You can't just be a cultivator. You have to kind of do all three. You have to only sell the product that you grow. You can't buy it from another grower and then sell it. So it does vary some state by state, but I would say most of them are separate licenses, and you typically can operate in more than one of those areas of the industry.
And for those who do want to own a vertical integrated operation where they're holding multiple areas or doing business in multiple areas, do they need to set up a certain business structure or different business structure than someone who's only going to do one area? And are there any industry requirements, I guess, around that business structure?
Yes, and that's a great question, because this one matters a lot. So, if your state provides different licenses for each of the areas in that industry, my advice would be to absolutely create a separate entity for each license that's being held. Now, like I mentioned earlier, in Florida, it's really just all or nothing, and it's one license. So because of that, in that instance in Florida, you kind of have to just do it as one business. You don't have the choice. But if you have a choice to separate those out, there's a few reasons why that is smart to do. For one, let's say we have three businesses: the grow, the processing, and then the retail dispensary store. Well, for one, if I set those up as individual LLCs at first, let's say that my grow is actually becoming very profitable very quickly, but my dispensary is kind of still growing, it's breaking even, or maybe even losing a little money. Well, if we have them separated, that gives me the ability to do special tax elections just on the cultivation and not affect my other two businesses. But if they're all lumped together, then I don't have that flexibility. So that's one reason. A second reason is for audit protection. This is something that we have to be very cognizant of because cannabis it's kind of in a weird, unique spot where it is legal on many state levels, but it is still federally illegal. It's a Schedule I narcotic, in fact. And that presents a lot of issues, that we'll get into. But under the tax code for cannabis businesses, we really have to keep a separate chart of accounts for each business activity or license that you hold. And so if I have all of my businesses together in one entity and that entity is audited, then I'm having to kind of turn over all of my books to the IRS. That's more risk for me. That's more expenses that they could disallow. Whereas if they're separated, it's highly unlikely that, this business, if it's audited, it's much less likely that they're going to expand that audit into my other businesses. And then I'm not having to give over more information that is absolutely required. So that's kind of our thought process on that.
Yes, and that definitely makes sense. Just with any other business, the numbers are important, and we talked about that a little bit. And in this particular industry, I'm learning that the accounting details are key. So what are some, and we've talked about a little bit, of the compliance points that this industry should be aware of, state-wise, federal wise?
For one, on the federal level, I want to get into 280E for just a second, because that's going to be blanket over everyone. So 280E is kind of the golden rule when it comes to cannabis tax and accounting. It's what we have to abide by. And what 280E is in a nutshell is the way it started is there was a guy named Jeffrey Edmondson who was an illegal drug trafficker. Honestly, he sold marijuana, cocaine, and many other illicit drugs. And kind of like Al Capone, he was arrested not on the trafficking of drugs, but on tax evasion.
Oh.
And so because of this, his legal counsel had a smart argument and said, well, if you're going to make us file tax returns and file income tax on all the money that our client has earned, then he should be able to deduct his travel expenses, his inventory expenses, all of those ordinary business expenses. And that made sense. And so they did go ahead and do that. They wrote off their travel, they wrote off their inventory that they purchased, even contractors and employees. And when it was all said and done, really he paid a lot less in taxes than I think the federal government was hoping for. And so in response to that, Section 280E of the Internal Revenue Code was enacted to kind of prevent this from happening again. And in a nutshell, what that means, there's two major parts to it. First part of it is any business that's involved in the trafficking of a Schedule I or a Schedule II narcotic, although they are federally illegal, they're still expected to pay income tax, but they are limited on what they can deduct as business expenses. In fact, the only thing that they are allowed to deduct is what is considered a cost of goods sold. And so the tricky thing about that is that a cost of goods sold is really not a tax deduction. It's really a reduction of income.
Right.
So yeah, if you don't have any income, then you really can't have any cost of goods sold. Even if you spent money getting your business started, you have to have sales in order to claim a cost of goods sold.
Right.
So that's the first part. And since we're limited to only deducting what is considered a cost of goods sold, 280E also enacts some really strict record keeping and accounting requirements. And what those records do is they substantiate what is and is not a cost of goods sold. So, a lot of businesses do general tax accounting. This is in a basic way, it's almost like a bank statement. It's listing debits and credits, and whatever's left over is the profit or the loss, fairly simple. With cannabis businesses, we have to figure out on the books for instance, let's use a grower as an example. Say that this grower he grows 1 pound of cannabis, and then he sells that pound for $2,500. What our books have to reflect is we have to figure out how much of his total electricity cost went into that 1 pound, how much of the total labor cost went into that, nutrient cost, all of these expenses. And on the books, we kind of have to marry those labor and nutrient expenses and all other, associated expenses with that sale to show, okay, we know that it costs this cultivator $1,000 to produce this, and therefore, if he sold it for $2,500, $1,500 is his, taxable profit. But with that, why the record keeping requirements are so strict is the method of accounting that they require is called U.S. cost gap accounting on an accrual basis. It has to be an accrual rather than a cash basis. And what we see the IRS do under audit is if that compliance is not met, if they determine that your record keeping requirements are not in compliance with 280E, they will claim that all of your cost of goods sold expenses are unsubstantiated and therefore disallowed. So those records are really our lifeline in an audit. They're what protects us. And so meeting those compliance measures of 280E is really crucial for any business owner.
Wow, that is really strict and specific.
It's really crazy that, a lot of people, when they, especially, here where I live in Oklahoma, we passed it to do medical marijuana, and a lot of people view it as a gold rush, almost a get rich quick situation. But there's a lot more that goes into it that a lot of people are not aware of. And even still to this day, I speak with cannabis business owners. Some of them have never even heard of 280E. And it's scary to me. So I'm glad we're doing this show to kind of put the word out there and let people know what their requirements are.
Definitely. And I know we touched on audits. So how common are audits, I guess, in this industry?
Well, we're in a weird spot right now with COVID. For one, they're typically, prior to COVID, they're very common. In fact, I think it's safe to say that they're almost, twice as likely, if not more than that, because it's a federally illegal business. With COVID happening, it turned the world upside down, and the IRS, it turned them upside down too, frankly. And they furloughed a lot of employees that they really desperately needed. So we've seen a little bit of decrease in audits very recently, but here's what we're thinking, and it's pretty widely expected that, we just passed a huge infrastructure bill that's going to cost trillions of dollars. The IRS is going to have to help pay for that. And so we expect that they're going to come back maybe more aggressive than they were before. And cannabis businesses, unfortunately, are an easy target for the IRS because the accounting measures that are required are so specific, and most of them are not meeting them. So it's an easy audit for the IRS to go through and disallow expenses and assess additional tax on. So just that much more reason to make sure that is being taken care of the way it's supposed to.
Yeah, almost like they'll be picked on a little bit because it's such a easy target.
Exactly. And then that's just on the federal level. On the state level, it varies. Some states, I haven't seen this happen just yet, but I know at one point Colorado had a goal of reaching something like a 100% audit rate every 5 years, basically saying, you're going to be audited at least every 5 years or so. That may be just slightly off, but it was something to that effect. And so, we've seen a lot recently is a lot of sales tax audits on dispensaries. A lot of states, they have to charge sales tax, but then they also charge an additional like medical marijuana excise tax. And so we're seeing a lot of those audits right now. And those are always from the state. So really, it is just an audit prone industry at this moment.